Markets are worried about lower interest rates. We are lower ahead of the final reading on the fourth quarter GDP. Global markets are watching trade talks between the United States and China, as well as the Federal Reserve, as some people are calling on the Fed to cut rates. That's how weak things have become across the world. Joining us right now is Nuveen, Chief Equity Strategist and Senior Portfolio Manager, Bob Dahl. Bob, it's good to have you on the program.
Thanks, Maria.
A lot to talk about with you today. We want to get into interest rates, the 10-year. We want to get into the global slowdown. But let's start with first quarter earnings, because they are on the horizon. The month of March ends next week, and we're probably going to see earnings come out in the next 2 weeks. What are you expecting?
Not great news. Earnings estimates for the first quarter have been coming down for months now. Last September 30, +7. January 1st, +4. Now, -3.
Wow.
You can't have earnings expectations keep coming down like that and stocks keep going up. There's some things that are going on. Slowing economy, slowing top line, and some pressure on margins.
So do you want to sell stocks going into the earnings season then?
I think I want to make sure I have stocks that I have high confidence the earnings are going to come through. Earnings disappointments are not going to be treated well. We'll probably get some confessions before the earnings are released. We'll watch them carefully. And, of course, as importantly, what do earnings look like for the second, third, and fourth quarters as companies release their thoughts about what's happening?
Yeah, that's the key thing. It's not what's happening now, what's going to happen in the future. And what are the prospects there? Do people see a comeback in the second half, especially if we get a trade deal with China, get those clouds removed?
The bulls certainly
I think you're right,
do.
because now people are looking toward 2020 earnings, right? They're sort of writing off what's going on. But you're right, it's bad numbers.
Yeah. There are a lot of people with a hockey stick for this year, Steve, as you know. Not so good in the first half, much better in the second. The compares don't get easy, really, till the fourth quarter. So we've got some tough sledding to go here in terms of comparing. And if we get any pressure on margins through labor costs, which are beginning to show, it's going to be hard to get back to significant earnings growth. So I think we got some tough sledding to go here for a little while.
How do you feel as you hear people predicting an impending recession? You know, I hear this phrase all the time. When you hear that, what's your response?
Well, I don't know what they're looking at.
Well, I'm looking at the 10-year. I'm looking at the 10-year. It's the lowest level in 15 months. Doesn't that indicate a recession is on the horizon?
I don't think so. I think it's telling us the economy is weakening and the cycle is maturing. But signs of recession, there aren't many.
It's not just the 10-year, it's the inversion of the yield curve where shorter-term rates are higher than longer-term rates, the 3-month versus the 10-year yield for 4 days in a row. The yield curve inverted and predicted the last 7 recessions in this country. We brought
with a lead of 1 to 3 years.
Right.
But yesterday you had breaking news on what the Fed is talking about right now.
So Dallas Fed President Robert Kaplan, who you've interviewed many times, was talking yesterday, and the Wall Street Journal writes about it today. And he said, if you see an inversion that goes on for several months, that's a different kettle of fish. But I need to see an inversion of some magnitude and or some duration, and right now we don't have either. He said, I'd be careful not to overread or overreact in any moment to what markets are saying, because they have the ability to change on a dime.
So he's saying don't cut rates right now.
And right, he's saying that the Fed is essentially, and I'm interpreting what he said, not poised to cut interest rates, short-term interest rates anytime soon, because that essentially is what, when the shorter-term rates are higher than longer-term rates, that's essentially what investors are predicting, and predicting slower growth.
Yeah, we've had an inversion frenzy, in my view. I mean, that's been the focus for the last several days. Not that we should ignore it. An inversion of the yield curve is not good news, but it doesn't say a recession's tomorrow morning. The lead, and I agree with the article here, it's got to last for a while before we start worrying about it, and we still have, on average, 1 to 3 years before a recession.
No, the recession is 2 quarters of negative growth. We're going to get the GDP this week, today, and we're going to see that, in fact, we're still growing.
Correct.
Well, I like what Dagan was saying. Don't overread or overreact.
No, that was Robert Kaplan. I was just reading.
Well, I know, but that mindset of when you look at investing, it's a long term, right? There are going to be some rides on this roller coaster, and the main thing is to keep your seatbelt on. Right. Have a game plan and have somebody to work with.
Real GDP last year, as we know, was about 3. This year, it's probably be closer to 2. And there are a lot of people say, well, I can do the math. 3, 2, must be 1 next year, and we're heading for recession. Not so fast. Economies are bumpy.
Having said that, the Federal Reserve is lowering its U.S. economic growth target, right? I mean, it's indicating that it won't raise interest rates this year. You look at Europe where it is, Steve. We're lucky if we see 1% growth in the Eurozone. You look at China and you see that that's slowing down. So how concerned are you about a slowdown? I understand it may not be recession, but we are slowing.
Back to where we started, earnings. We are slowing, and earnings are the first place we're going to see it. You cannot have double-digit earnings growth if the economy is slowing.
So how do we stimulate the economy here? Clearly, the Federal Reserve really can't do it. It tried 8 years of quantitative easing. European central banks now going to make cheap loans to banks again. We know that's not going to work. They're not making structural changes. What constructively, two questions really. Is the role of the Federal Reserve grossly overrated? Should they just take a long-term vacation? And number two, what should the government do to stimulate? Do we need a tax cut, even though the House may not pass it? Put on the table, saying we're going to try to do positive things.
By the way, there are some people who think we're going to see a huge spending bonanza toward the end of the year again.
But spending does not work.
I know. I'm just telling you, we're already talking about $22 trillion in debt.
Correct.
Is that the kind of stimulus you're talking about?
Well, out of the Trump administration is starting to come some noise that they're going to want to spend some more money to get the economy going heading into the 2020 elections.
That gets to the basic question. Where does the money come from?
I can tell you where it comes from.
I'm with you here, Steve.
I can tell you where it comes from.
Ridiculous.
I've been sitting on this article for more than a week waiting to talk about it.
Here we go.
The gas tax hike, Steve, that the U.S. Chamber of Commerce has come out in favor of raising the gas tax from 18.4 cents, where it's been since 93, 94, by 25 cents over the next 5 years to fund infrastructure spending. So U.S. Chamber of Commerce.
They always come up with higher taxes. How about lowering taxes? It worked
How
in
about making the
2017.
individual tax
I remember
permanent?
somebody named Steve Forbes running for president talking about that very thing.
Flat
you want to try
tax.
again?
Discouraging. 20 years later, we're still
talking about the flat tax.
Yeah. Same song.
So, okay, so how do you, with all of this now, how do you allocate capital in this environment?
more carefully. I think the easy money for the year has been made in the stock market. Therefore, it's more an alpha rather than a beta world. I've got to be in the right stocks. You want to own stocks that have some exposure to the economy, companies that are generating free cash flow. We have to recognize the consumer's in pretty good shape, companies that can raise prices or have new products. And I'm still of the view, have more of your earnings geared in the U.S. than outside, because despite our problems, the problems there are worse.
All right, we will leave it there. Bob, it's great to get your insights.
Thank you.
Stop by more often, will you please? Bob Dahl joining us there.